The Federal Reserve's been getting a ton of pressure from large corporate business owners, politicians, economists, so on and so forth, for their persistent raise of the federal funds rate in every FOMC meeting since March of 2022. They've been, I believe they're at their 10th or 11th straight raise in a row. And many are frustrated with it, and many can't fully understand what the Federal Reserve's driving force is. Why are they so persistent, even though they're increasingly putting pressure on the economy, which is why obviously a lot of these business owners are so upset with the Federal Reserve, because their businesses are taking a hit due to their monetary policies. So they have a different perspective on it. What I want to cover in this video is what economic force that the Federal Reserve is terrified of, why that's driving them to be so persistent with their rate hikes. I want to explain what that economic force is. I want to explain how it, why it's so terrifying, how you need to maneuver around it, what happens to the asset markets, the overall economy if the Federal Reserve is unsuccessful at getting inflation down in time. I want to cover that for you so you can understand what happens with your retirement accounts, what happens to your business, what happens to your personal finances, your access to capital if the Federal Reserve is not successful. I want to cover all of that in this short video, so stay tuned all the way to the end. This is JP from Blueprint for Prosperity. We're going to get straight to it. So the Federal Reserve is terrified of stagflation. Simple. And those of you who are not, economists or finished with a finance degree, stagflation is the economic phenomenon of a stagnant economy, unhealthy, high unemployment, and high inflation at one time. And this is an absolutely terrifying economic cycle. And the reason is because the monetary policies needed to fight those are opposing to each other. What it takes to fight inflation worsens economic downturns. What it takes to support an economy in a downturn worsens inflation. The Federal Reserve has to drain liquidity and money out of the system, has to make money more expensive to borrow, along with other levers in order to subside inflation, because we are a debt-based, consumer-driven economy. So if we take money out of the system by making it more expensive, less people, less businesses can borrow. When that happens, less of them can spend money. So less consumerism, less expansionism, less employment, slower wage growth, so on and so forth. There's less money flowing in the system, less money going into the system. This is what fights inflation, generally speaking. When you start to talk about what it takes to fight an economic downturn, they have to do the opposite. They have to cut interest rates. They have to pump more money in the system. They have to make money more affordable and easier to access. When that happens, businesses and individuals can borrow more. And when they can borrow more, they typically spend more. And that means more businesses expand. They hire more people. People get hired. They make more money. They spend more money on stuff. And that is what supports economic downturns. We went through that with COVID. They slashed interest rates. They pumped a bunch of money in the system through, the government and the Federal Reserve came together and pumped a bunch of money in the system. And people had access to liquidity, capital, assets were inflating. The stock market went up. Real estate went through the roof. People were spending money. It was just a big boom. Now we're dealing with inflation for a year straight. The Federal Reserve has been pounding the hammer on inflation since March of 2022. Understandably so. They were late to the party. Inflation had been showing signs, or at least the argument of what drives or causes inflation has been brewing for months, maybe even a year, before the Federal Reserve even decided to acknowledge it. The Federal Reserve was on record multiple times saying inflation wasn't even a thing. When it came along, they went months saying it was transitory. Once they realized they couldn't, deal with that reality, that transitory wasn't going to work, then they had to start dealing with it. And that's what we've been seeing since March of 2022. Now people are screaming from the rooftop, the same ones that were saying the Federal Reserve's taking too long to come to the party, inflation is going to be a problem. Many of them are now screaming from the rooftop, stop, relax, slow down, you're doing too much. Well, unfortunately, the Federal Reserve and Jerome Powell is not going to let up. And I'll tell you why they're not likely going to let up. Because of what I just said, stagflation. If they are not able to get inflation down before an economic downturn or recession truly kicks in, we are all in a world of pain. And what I mean by that is The Federal Reserve, by its own projections and admissions, expects unemployment to go up at least 1% by the end of the year. We're at around 3.4, 3.5. They're expecting it to be at around 4.5 by the end of the year. That's just one projection. And then they're also projecting in the next 2 to 4 quarters for us to be officially in a recession at the current trajectory that we're on. So that basically means, as I already stated, that is 2 of your 3. Unemployment is going to start going up. Now, 4.5 isn't enough to call it high unemployment, but it's going to start going up. Economic downturn, recession is expected to officially be announced, or we're in it sometime in the next 2 to 4 quarters, puts us at the end of the year or the first half of next year. The third one, we're already dealing with higher than normal, higher than healthier inflation. If the Federal Reserve lets their foot off the gas too soon, does not get inflation under control, and it starts to reverse itself, because that's what it does. It doesn't just stagnate. What'll happen is that the Federal Reserve will stop and inflation will start to not only be higher than the 2% mark, but it'll go up. That happens, and the rest of those indicators that they're projecting kick in, and unemployment starts to go up from their tight monetary policy, and the economy slides into a recession from their tight monetary policy, then that means the economy broke before inflation did. That is the worst case scenario. Absolute worst case scenario. So what that means is every tool that the Federal Reserve has to fight those economic factors or economic cycles is now the guns are pointed at each other, if you will. What they need to fight one boosts the other or makes the other one worse. So what does that mean? If hopefully that makes sense to you so far, hopefully you're following. If not, rewind the video or leave comments down below so I can give better clarity. But hopefully that adds up for you so far. What does that mean for you as a business owner? What does that mean for you if you're worried about your retirement account? What does that mean for you for your overall economic circumstances, personal finance circumstances? What that means is, we'll start with business owners. You have an economic cycle where liquidity is dried up because the Federal Reserve has made money more expensive to borrow. And so that automatically slows businesses down, raises unemployment, puts less money in people's pockets. And then when people have less money in their pocket and they have less ability to borrow, they can't spend money. If they can't spend money, then they can't support your business. They can't buy your products. They can't pay for your services. So if less people can buy your products and pay for your services, and as a business, you're having a harder time getting access to capital, where's the money going to come from? Exactly. Nowhere. So that's the negative, grim picture of stagflation for a business. One example of stagflation for a business. The next problem is, what happens to the asset markets? We'll mostly stick to stocks and real estate, since crypto is largely speculative. The stock market is made up of what, ladies and gentlemen? Businesses. I just described how businesses, large, medium, and small, are going to suffer because they won't have easy access to capital, cheap capital, to sustain or grow, and consumers can't afford to buy their products and services. So anybody that is not an essential is going to suffer. And even some of the essentials aren't going to be doing great. But some of these companies that have, leisure, that are, more of a leisure spending, things that people don't necessarily need, they're going to be in a world of pain. And that in turn means that their valuations will also be in a world of pain. So that means the stock market's going to what? Be highly unattractive. On the flip side, real estate is the lagging indicator out of the bunch. What that basically means is that real estate is the last to respond in the asset markets into the economy. So that means that the effects of stagflation, we haven't even really seen the effects of inflation in the real estate market necessarily yet. We haven't seen the effects of the Fed's rate hikes necessarily in the real estate market yet. And so if stagflation kicks in, it's a whole nother beast, because as we also just described, the real estate market is only propped up right now because even against the Federal Reserve's higher rates, because there's a massive inventory issue. That massive inventory issue is allowing the real estate market to stay propped up in the price range and in rents for the most part, because there's not enough homes. And even with the Federal Reserve pushing up on rates, even with the Federal Reserve, putting downward pressure on the housing market, there's still too many people looking to rent or buy homes in most markets for the prices to come down. So we're still seeing slow price increases. Not only is it not crashing or not significantly declining in most markets, but rents and prices are inching up bit by bit. So if you have stagflation, that potentially changes, because you're going to start to have a whole bunch of people who are starting to lose their job, incomes are slumping, and expenses are rising, and they're not going to be able to make their mortgage payments or their rent payments. So that means that the inventory crisis that we're having, the affordability crisis from the inventory issues, spinning off from that, is starting to turn over on itself. We are now likely increasing the chances that there's going to be a massive flood of inventory that people have been waiting for, in some cases, to happen, come to the market, because people can't afford to make their payments anymore due to the economic circumstances that I explained prior. So if that happens, people can't afford to make their mortgage payments, they can't afford to pay their rent. Well, now you start to have foreclosures. It's going to be, the federal government's been breaking its neck to avoid foreclosures since COVID. There's all kind of programs in place. There's all kind of forbearances, and all these other things. But COVID is long behind us, economically speaking, for the most part. And the reality is that these companies are going to want, the lenders and landlords are going to want their money. And there's only so much policy you can put in place to stop that. So we could end up with a situation where real estate finally starts to slide because inventory will pick up, possibly. And that will be its own disaster in the real estate market. Now, if you're an investor sitting on the sideline with a bunch of cash or a bunch of liquidity, and then you might be attracted to the idea that there's going to be a bunch of real estate available in the market. But for the majority of us, that's bad news. So I just kind of broke down what that means for your business. Hopefully now you're tying the knots to what this means for your retirement account, depending on, what you're investing in your retirement account. So what do you need to do, or how do you need to prepare for this? To wrap this video up, what I just broke down, the biggest problem is going to be a lack of liquidity, a lack of cash, and a lack of borrowing, a lack of capital to borrow. You need to be in the best financial position when it comes to your credit, solid, sturdy banking relationships where banks, when they get nervous, will still feel comfortable lending to you. And if you're in position, stack your cash flow. Don't make any risky investments. Don't quit your job right now. Don't transition jobs if you don't have to. Be conservative and stack cash, not just for opportunities to invest, but for survival. You don't know where the bottom is going to come in if we run into these economic circumstances I just described earlier in this video. So you need cash to sustain and secure yourself. And if you can do that and still find opportunities, then go for it. There's real estate opportunities and you know what you're doing. If there's stock market opportunities and you know what you're doing, you got the cash, go for it. You can support your business, go for it if you want to expand your business. But the key survival fuel is going to be capital, liquidity, savings. That is what's going to save people and businesses if we run into stagflation in the near future, in the next 2 to 4 quarters or so. If the Federal Reserve, which they're doing a great job so far, inflation is coming down precipitously, consistently, but it is getting stubborn. It is getting stubborn, which many people projected. That's not new. But at the end of the day, we cannot assume that the success that they've had, the past performance, is going to be an indicator of future success. So we don't know if the Federal Reserve is going to close this show all the way out and get it down to that 2% range. If they can't, and those other economic factors arise at the same time, you better have access to some cash. You better have sturdy credit. If you're a business, it's going to help to have business corporate credit. Have all of that in place because you're going to need access to capital. Banks are going to still lend. I just shot a video about that. They're going to still lend, but they're going to continuously lend to the best qualified, most familiar borrowers. That's a fact. You want to be one of those people or one of those businesses. So hopefully I tied this all together in for you nicely. I appreciate you for tuning in. I know this video is a little bit longer, so I appreciate those of you who stayed focused and stayed all the way through. I know this was a thorough education for you. Drop your comments down below. Let me know what you have questions about. Let me know what your commentary on this is. Let me know what your predictions are about where things are headed. I'd love to hear about it so we can keep the conversation going. Other than that, as always, to all my pioneers out there, I want you to stay focused, stay in motion. See y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.